Welcome everyone. In this presentation, we'll look at how to value gold and silver mining stocks using a structured 10-step approach. Mining stocks can offer substantial upside, but they are also more complex than most sectors because valuation depends on geology, commodity prices, operating performance, management quality, jurisdiction, and capital structure. That complexity is exactly why a systematic method matters. The goal here is to give you a practical framework for identifying stronger companies, avoiding weaker ones, and making more informed investment decisions. This approach is designed to simplify the process without oversimplifying the risks. A systematic approach is important because mining investing combines significant opportunity with significant complexity. The upside can be substantial, but success depends on evaluating a wide range of variables correctly and in the right order. Unlike simpler businesses, mining companies are tied directly to physical assets, and those assets must be assessed from geological, financial, operational, and geopolitical angles. A checklist-based approach helps investors avoid missing critical details, reduces emotional decision-making, and creates a repeatable process for comparing opportunities. In short, structure improves consistency, lowers risk, and leads to better investment judgment over time. This valuation method was developed over many years through practical experience and continuous refinement. It began with a focus on gold mutual funds in the early 1990s, then expanded into silver mining stocks as the need for more specialized analysis became clear. Over time, deeper research, trial and error, and repeated exposure to real market cycles helped shape a more reliable framework. That eventually led to a structured 10-point checklist designed to organize complex information into a practical investment process. The value of this method is not just theory, it is built on experience, discipline, and repeated application. The reason this systematic approach matters so much is that mining stock valuation is inherently multidimensional. Investors need to assess geology, economics, operations, jurisdiction, financing, and management all at once, and every one of those areas can materially affect value. A structured method breaks that complexity into manageable components and ensures that no critical factor is overlooked. It also improves the quality of risk assessment and return forecasting, because conclusions are based on evidence rather than instinct alone. Ultimately, a systematic process gives investors a far stronger basis for deciding which stocks to buy, hold, or avoid. One of the main benefits of a systematic evaluation checklist is that it improves both discipline and decision quality. First, it strengthens risk management by helping investors identify geological, operational, and market-related weaknesses before capital is committed. Second, it makes return forecasting more realistic by forcing a closer look at cash flow potential, resource quality, and overall upside. Third, it supports better decision-making by replacing guesswork with a consistent, analytical framework. In a sector as volatile as mining, that combination is powerful. A structured checklist does not eliminate risk, but it significantly improves the odds of making better choices. Step 1 is evaluating the property itself, because in mining, the asset is the foundation of the investment case. Before looking at valuation ratios or market excitement, investors need to understand what the company actually owns. The quality of the property will determine future revenue potential, operational viability, and long-term upside. A strong property can support growth, cash flow, and investor confidence, while a weak property usually creates problems that no amount of promotion can fix. That is why property evaluation comes first. It sets the stage for everything that follows in the valuation process. Within property evaluation, flagship assets are especially important. A serious mining company should ideally have a cornerstone project with enough scale and economic potential to justify long-term attention. In this framework, that usually means at least around 2 million ounces of gold or 40 million ounces of silver to qualify as a meaningful flagship asset. Projects of that size tend to provide more credibility, a clearer development path, and a better foundation for future cash flow. By contrast, companies without a true flagship property often carry more uncertainty and may be much riskier from an investment standpoint. Property size and mineralization potential are key parts of evaluating whether an asset can become truly valuable. Larger land packages provide more exploration room, more optionality, and a higher chance of making additional discoveries over time. At the same time, mineralization needs to show meaningful scale, continuity, and multiple targets rather than a single isolated zone. Long strike length and district scale potential are especially attractive because they increase the probability of building a substantial resource. For investors, the takeaway is simple. Size alone is not enough, but size combined with strong mineralization can be a powerful value driver. Exploration and pipeline projects are the engines of future growth. A strong exploration program keeps the story alive by generating news flow, expanding resources, and creating new discovery opportunities. In this framework, regular drilling and consistent technical updates are not just promotional tools. They are core drivers of long-term value creation. Beyond the flagship asset, a robust project pipeline adds strategic depth by giving the company multiple ways to grow over time. Investors generally want to see both: a core asset with real value today, and a pipeline that can support expansion, optionality, and continued market interest tomorrow. Mine life and ownership are two essential factors that are often underestimated. A long mine life generally supports more stable production, stronger long-term cash flow, and a more durable valuation. As a rule of thumb, a mine life of at least 10 to 15 years is far more attractive than a short-life operation that may quickly run out of economic value. Ownership also matters. The closer a company is to full control of its flagship asset, the more it benefits from decision-making authority, economics, and strategic flexibility. Low ownership in a key asset can be a serious warning sign. Step 2 is assessing the management team, because in mining, execution is just as important as geology. Great assets can still disappoint if management lacks operational skill, discipline, or credibility. The first things to look for are deep industry expertise, a proven track record, a strong reputation, and the ability to make sound decisions in complex environments. Mining projects require capital allocation, technical judgment, stakeholder management, and risk control, so leadership quality has a direct impact on outcomes. In many cases, backing the right team is what determines whether a promising project becomes a successful investment. When evaluating management, it is important to distinguish between different types of teams. Some companies are developers, meaning they are focused on building and operating mines, which requires a very specific set of technical and operational capabilities. Others are project generators, which focus more on discovery, early-stage advancement, and monetization through partnerships or asset sales. Both models can work, but they carry different risk profiles and require different leadership strengths. In general, developers need proven mine-building experience, while project generators can be less operationally intensive. Understanding that distinction helps investors judge both risk and growth potential more accurately. Investor friendliness and management alignment are critical because they directly affect how value is shared with shareholders. One of the strongest signals is management ownership. Real skin in the game helps align incentives with outside investors. A meaningful ownership stake often suggests stronger discipline and less willingness to dilute shareholders unnecessarily. Investors should also look for management teams that communicate clearly, prioritize shareholder value, and maintain transparency around strategy and capital allocation. On the other hand, low insider ownership, repeated dilution, and poor communication are major red flags. Alignment matters because even good assets can underperform under shareholder-unfriendly leadership. Step 3 focuses on share structure, starting with the difference between outstanding shares and fully diluted shares. Outstanding shares reflect what is currently trading in the market, but fully diluted shares give the more realistic picture because they include options, warrants, and other potential sources of dilution. That matters because conversions increase the total share count and reduce the value represented by each existing share. For mining investors, this is especially important because many junior companies rely heavily on equity financing. Evaluating only the basic share count can be misleading. The fully diluted count is what reveals true valuation and dilution risk. Building on that point, investors should think of dilution not as an accounting detail, but as a direct driver of value per share. A company may have an attractive resource and a compelling story, but if the share count expands too aggressively, much of that upside can be spread thin across too many shares. That is why dilution needs to be analyzed early and consistently. Review options, warrants, future financing needs, and incentive structures carefully. The goal is to understand how much of the asset truly belongs to each shareholder on a fully diluted basis, not just on the headline share count. A tight share structure can significantly increase value potential because it concentrates asset ownership into fewer shares. In simple terms, when a company has fewer fully diluted shares relative to the size of its resource base, each share represents more intrinsic value. That can also improve market responsiveness, because even modest gains in investor interest can have a larger impact on price. Tight structures are especially attractive in mining because they create stronger leverage to discovery success, resource growth, and commodity price moves. For investors, share count is not just a statistic, it is a key part of valuation quality. The practical guideline here is to favor companies with healthy, disciplined share structures and to be cautious with heavily diluted names. As a rough rule, mining companies with fewer than about 100 million fully diluted shares are generally more attractive from a structural perspective, while companies above roughly 150 million shares deserve extra scrutiny. A highly diluted company is not automatically uninvestable, but it needs to be exceptionally cheap or have extraordinary upside to justify the risk. In most cases, tighter structures offer better value per share, better market appeal, and a stronger setup for long-term returns. Step 4 is assessing location and geopolitical risk. Even an excellent project can become a poor investment if it sits in an unstable or hostile jurisdiction. Investors should prefer mature mining regions with predictable laws, stable governments, established permitting systems, and a reasonable relationship between the industry and local communities. Location also affects infrastructure, security, compliance costs, and project development timelines. In other words, jurisdiction is not just a background issue, it directly impacts economics and execution. Strong jurisdictions tend to reduce risk, while unstable regions can destroy value through delays, policy changes, and rising uncertainty. Mining-friendly jurisdictions offer several clear advantages. They tend to have mature legal systems, more predictable permitting, and stronger protections for capital. They also usually provide better operating visibility, which helps companies advance projects with less uncertainty and fewer surprises. Regions such as Canada, the United States, Mexico, Australia, and selected parts of Latin America are often favored because they combine geological potential with more established mining frameworks. For investors, the benefit is straightforward. When political and regulatory risks are lower, management can focus more on execution, exploration, and value creation rather than fighting avoidable external disruptions. By contrast, unfriendly or high-risk mining regions can significantly reduce investment attractiveness. Political instability, resource nationalism, sudden policy changes, license uncertainty, and legal unpredictability can all damage project value. In the worst cases, they can halt development altogether or lead to asset nationalization. Even when production continues, these risks often mean higher costs, lower investor confidence, and greater stock volatility. That is why jurisdiction should always be treated as a core filter, not a minor detail. Protecting capital is just as important as finding upside, and choosing safer jurisdictions is one of the most practical ways to do that. Infrastructure and ecological considerations add another important layer to jurisdiction analysis. Good infrastructure, including roads, power, water access, and available labor, can dramatically improve economics by lowering capital costs and reducing operational friction. On the other hand, remote locations can require major upfront spending and create long-term logistical challenges. Ecological and social factors matter as well. Community opposition, indigenous rights issues, environmental litigation, and permitting uncertainty can all delay or impair projects, even in otherwise mining-friendly regions. Investors should therefore look beyond the map and evaluate how practical, buildable, and socially sustainable a project really is. Beyond the first 4 steps, investors should also pay close attention to several additional valuation factors. Resource classification matters because not all ounces are equally reliable. Measured and indicated resources deserve more confidence than inferred material. Cash costs per ounce are essential for understanding operating efficiency and margin potential. Recovery rates affect how much of the resource can actually be converted into revenue. Company cash flow, debt levels, financing needs, project timelines, and exploration news flow also play a major role in valuation. Together, these factors help complete the picture and turn a good checklist into a more comprehensive investment framework. When all of these elements are combined, valuation becomes a far more disciplined and effective process. Mining stock analysis is not about relying on a single metric or chasing excitement around a story. It is about integrating geology, management, capital structure, jurisdiction, and financial quality into one coherent framework. A structured 10-step checklist helps simplify that complexity and makes comparison across companies much more practical. It also improves decision accuracy by forcing investors to think in a consistent way. Ultimately, that discipline is what helps uncover stronger opportunities while avoiding many of the mistakes common in this sector. To wrap up, the key takeaway is that mining stock investing becomes much more manageable when you apply a systematic process. Prioritize flagship assets, capable management, disciplined share structures, and favorable jurisdictions. Combine that with careful attention to costs, cash flow, exploration progress, and financing risk. The goal is not to eliminate uncertainty, that is impossible in mining, but to improve decision quality and stack the odds in your favor. If you continue applying this framework consistently, it can become a strong foundation for identifying higher quality opportunities and building a more disciplined long-term investment approach.